market. Then we'll hear from Ryan, and we will have a few minutes at the end to take some questions. So with that, let me jump into the, first of all, actually, before I jump into the economics analysis, we can go to the next slide. I did want to just, in case you've missed it, just recap a few of the things that have happened here in 2023. As I mentioned, we hosted Investor Day. We've also hosted Rating Agency Day, which many of market participants would not have access to, but it's a very critical component to both our reinsurance and our capital markets programs. We had attended the reinsurance conference here in DC, as well as out in Vegas and in New York. We did road shows down in Bermuda. We've had this webinar and podcast. So we're very, very active as typical. I will also note that we've been continuing to try to improve the access that you all can have for our business intelligence portal, which is Clarity. A big change that we put in this year, a big enhancement, I should say, is we've now joined the MBS usage data as well. So in one spot, you can come in, you can go over, you can do MBS analytics, you can come in, you can do CRT analytics. Most desks out there are independent, so you tend to go to one or the other. But we have seen quite a bit of pickup in usage since we've made those enhancements to the Clarity portal. We've also made enhancements to EU disclosures, Annex 2, loan level, both Annex 2 and 12. 12 is coming. So give us feedback on those, but that we've been hearing requests to enhance those disclosures to comply with various EU disclosure requirements. And that's now, those are enhancements on Clarity. Let's dig into the economics if we move to the next slide. One more. Thank you. Yeah, so for the first piece is GDP continues to be a positive. So we never hit the technical recession. We had a few quarters back of back-to-back GDP becoming smaller. That's not a definition of recession. I think we've covered that in the past. Most of you all know that. But we should say it's the third quarter in a row where we have positive GDP growth. We're now at an annualized rate of 1.3%. So if we move forward to the next slide, where does that, our baseline says recession is off the table. It's still clearly a possibility. In terms of the potential of a soft landing, that seems to be a larger potential of that happening than what we would have thought of previously. Clearly driven by consumers. We saw some soft prints in consumer spending, although markets today do seem to be reacting positively to that. But it could change, of course. It's all very highly dependent upon employment and the direction of the economy. So let's look at employment. Next slide. Unemployment was up 0.3% in May. So that headline number is on the negative side. However, job openings also increased, and the ratio of job openings to unemployed persons actually increased. So despite the rise in unemployment rate, we're continuing to see a very, very strong labor market. We're continuing to see an overall economy that is less interest rate sensitive, at least up to this point. Again, things could change going in the future, but we've continued to see strong payrolls, 339,000 reported in May. Next slide, please. What's happening with inflation? It's still high, but it's slowing down. It's off of its peak. The print for April was 4.7. The print in May, 4.6. So we're still not at that 2% target rate, or Fed's target rate for inflation, but clearly a lot of work has been done and inflation is coming down, which is continuing to help the consumer in terms of overall prices. Next slide. Let's look at some of the mortgage trends. We'll go 2 more slides. One more. Mortgage rates. As of when we put this deck together, we're peaking up at just around 6.8. We did actually touch near the 7s briefly over the past couple weeks, although it's come back down. So as we would expect, I'm sorry, can you go back one slide, please? Thank you. So as we would expect, originations are negatively correlated to rates. And so originations are way down for the year. According to our estimates, mortgage originations Q1 were just 344 billion. That's the lowest since 2014. And related to that, the share of originations that are purchased are very, very high. And so you can see that here in our chart that purchase as a share of overall is dominating originations. And that, of course, I think will make sense to many of you, as a large portion of our outstanding book is effectively in the locked-in effect, right? Folks have mortgages with very, very low rates compared to our high sixes, and it's going to take a lot for them to move off of that. Next slide. So related to that, what we're seeing is new home sales are the dominant, or not dominant. New home sales are becoming a higher and higher share relative to history of total sales. So the market is absolutely dominated by existing home sales. That's the lion's share of the market. Those existing homes do have this locked-in effect, or are being influenced by the locked-in effect, and that is the underlying mortgage. The homeowner with the underlying mortgage has such a low rate, they have a lot of incentive to not give up that rate. And so we are starting to see new home sales as a percentage of total home sales climb. Next slide. Inventory for homes continues to be low. So existing supply there's a 2.9 month supply for existing homes. That's very low. New homes do have a 7.6 month supply. Generally, like a 5 to 6 month level of supply, that's considered to be a healthy range. So looks to be a little bit of starting to be overbuilding on the new supply, but that is a very welcomed given the dearth of total supply. According to NAR, existing homes remain on the market for only 22 days in April, a very, very short time frame. So the tailwinds for the housing economies remains very strong. Lack of supply continuing to catch up related to demand, helping to boost HPA. So if we look at HPA, next slide, please. HPA continues to firm up. Our official HPA outlook as of this point continues to be negative, but it's firming up. Clearly, home prices are sensitive to interest rates, although it seems to be less sensitive than maybe we would have anticipated given the rise in rates. We have observed HPA declines. Some indices out there are actually starting to show gains. So the market has went through rapid home price appreciation, some level of adjustment, correction that seems to be firming up, and we'll continue to watch it. Again, very dependent upon employment. What does that mean for delinquencies? Next page, please. Mortgage delinquencies continue to be very low. With a strong labor market, employment very high, we're continuing to see extremely low delinquency rates, and we're going to do a little bit of a deeper dive into it in the later section, and both for the CRT portfolio and the Freddie portfolio. So that could change again with a change in unemployment, but the numbers that we're seeing is we're currently seeing signs of an extremely resilient economy. Let's jump into CRT a little bit. If we go forward 2 slides, where are we at in the CRT space? CRT issuance volume is low. As we said back at the webinar that we did in January, we were anticipating a significant reduction in new issue supply that Freddie Mac would bring in 2023, and it's exactly playing out that way. We've printed 2.75 billion of issuance to date. We're on a path to print 4 to 5 billion range by the time we get to the end of the year. That's the general area. That's down significantly from the low 20s that we did in 22. Largest driver of that is the refi volumes, as we showed earlier. Overall originations are down, GSE volumes are down, Freddie Mac volumes are down. That's translating into what we're issuing for CRT. That's the main driver. That said, we are continuing to attract a wide range, a very broad breadth of investor participants, both in our capital market stacker transactions and our reinsurance market ACES transactions. We have 11 new participants to date, and I'll dive into a little bit more of the composition. That the composition has shifted, but before we do that, let's look at spreads. We move to the next slide. I should also mention that we've continued to be very active in the tender space. So although new issue definitely is down, some of the activities have been supplemented with the tenders as we continue to be seeking to repurchase non-economical outstanding CRT. Spreads in 2023 across both markets seem to be less sensitive to the reduced volumes. Now, we know that there are other issuers out in the marketplace, and our reduced volumes aren't the only drivers, but overall volumes are down. But spreads are not. Spreads remain elevated. So if we look year over year spreads of the 23 DNA2 for stacker compared to the first deal of the year across the capital stack from M1A all the way down to B1, we're seeing a substantial jump in spread. So the B1 for the 22 transaction was at a spread of a SOFR plus 340. We're now seeing a SOFR plus 760. And even at the M1A, the most remote risk that we're selling, we were at SOFR plus 100. Now we're at SOFR plus 210. So again, less sensitivity in terms of supply demand related to spreads, and that's also applicable to the reinsurance markets, where you see a very similar trend. Comparing our first transaction of the year in 22 SPL1 compared to our recent 23 SPL2, B1 spreads have moved significantly from 325 to 610 basis points, and similar dynamic for even the top most risk remote component that we're selling to M1, which has moved from sub 100 to mid 200s of a spread. So clearly, the market, is being driven by multiple factors. The economics of the transactions are much more challenging for us at these spreads, and this is a trend that's persisted since post-COVID. If we go to the next page, it's not just from last year. We can see that these elevated spreads have continued to rise since 2021. So you can draw that dashed line from when we're coming out of COVID, right? We had spikes of COVID during 20. We came out of post-pandemic. Well, I know it didn't really end then, but from a marketplace perspective, we started to have business as usual kind of transactions towards the end of 20, moving into 21, and you can see spreads have been elevated since then, quite significantly. So this is a long-term trend for us, where we're continuing to see the market require higher and higher spread premiums, and that is despite the backdrop of lower volumes, and then of course continued low, very, very low losses, which we'll go over that in a minute. Yeah, that's all I'll say about that. We'll move on, please. Next page. Same, and it's not isolated to stacker. I should have highlighted that was a stacker chart, but we're seeing something very similar in the reinsurance markets. Again, let's look at the B1 spreads. For our most recent transaction there, 22 SPL4. Those spreads were in the mid 400s. I guess we're kind of low 400s on that on our 23 transaction, but again, well above where we were at the beginning of 21. So general long-term, multiple year of elevated spreads, at least historically. I will remind folks, CRT turns 10 this year. This month marks the 10-year anniversary of the stacker transaction, and then later this fall we'll have the 10-year anniversary of our first ACES transaction. Moving forward, where do we look at investors? I touched on this briefly I do think the upside of the spreads is we continue to attract a lot of wide breadth of investors. That's a sign of a healthy market. So we have 121 unique investors year to date. The composition of our investor base has shifted, with hedge funds becoming a much larger share of our total placement. And again, maybe there's a relation there with our spread. So overall, year over year, 22 to 23 year to date, we do see down volumes related to reinsurance. And we're looking at the M bonds. We see down volumes related to the reinsurance. Money managers are pretty much on top, but a very substantial growth in the hedge funds. On the B bonds, you see a similar pattern where reinsurance is down, money managers is down, and then nearly, almost a 35 point pickup in hedge funds. So that's the mix of our investors have changed a little bit this year. But again, still very, very broad. When we look at the next slide, we'll just note that we continue to have a healthy secondary market for our capital market stacker offering. I think we work with some of the best broker dealers in that space, and they're doing a fantastic job supporting the market. We'll note that stacker represents the majority of GSE secondary trading, with more than a 50% share, 11 of the last 12 months, related to the stacker QSIPs. Where are we at on performance? At the end of the day, these are credit bonds. Performance, really, there's not much of a new story to say than since last time we were here in January. Performance remains robust. I will note that the y-axis, the maximum level there is 2.5 basis points. So I just want to highlight that we're talking about 2.5 basis points. Most of our transactions have currently minimum 75 plus basis point risk retention on our front. Going back over the years, most of our transactions would have had a minimum of 25 basis points. So actual losses, collateral losses remain to be very, very low. You do see in that 2019 has 1.75 basis points of loss. Of that, the most of it is mod losses. We've certainly heard on the road shows, a lot of concerns, potential concerns with mod losses and what that might mean, which is why we've invited Ryan to come in and talk about how we view our loss mitigation programs and how we think it's a good trade to take some type of mod related losses in exchange for avoiding disposition loss or a credit event loss. We can definitely say against these economic backdrops, the performance is very outstanding. Again, 2.5 basis points. None of these transactions are above 2 basis points. And most of our transactions have a very significant retained first loss position. But what about the future? What about the pipeline? So if we look at the next slide, our losses on the horizon, again, they always could be. It's always, if employment changes, HPA changes, things could become very different. But what we've observed lately is that the near-term pipeline of losses, which you'd expect out of serious delinquent loans, has been improving. So we've come off our COVID peaks. On the left-hand side is comparison for all of the Freddie Mac book compared to some of the other major players in the U.S. residential mortgage space. And our overall losses have continued to trend down. We're now near that 62 basis point mark. Looking on the right-hand side, specific to the CRT portfolio, which has some exclusions from our total portfolio, you can see that continues to trend down to 43 basis points. So the near-term trend is very positive in terms of the pipeline of delinquencies. One more slide, if we go look at the next one. When we look back a year ago, these loans are curing. The delinquency rate is improving. I've just covered that. Well, what happened? What was the driver? So if we look at loans that were current back in July of 2022, 94% of those are still current. 5% are prepaid. What about the loans that were SDQ in that 90 to 150 day bucket? 61 of those loans are current. 61% of those loans are current, 11% are prepaid. And then we have some loans that are then distributed. 113% have transitioned to 180 plus. So transitioned out of this bucket into a worse bucket. 13%, basically 83% have improved. Of the loans that were seriously that next stage, 180 days delinquent, of that, you're seeing still something very similar. 60% are current, 12% are prepaid. 1% of those have transitioned into a credit event. So the performance combination of the underwriting, the collateral, loss mitigation, backdrop of the economy, strong jobs, strong employment, have yielded again for many years in a row. Now we've had extremely low losses. So I went through that quickly. We will be posting the deck. You'll be able to dig into it. We'll also have a few minutes at the end to take some questions if folks want to ask that. But I would like to ask Ryan to come on air. So Ryan, if you can come on, I'd like to turn it over to you. And again, Ryan, thank you very much. I'll tell the audience you're on vacation and you had previously committed to this date. So we very much appreciate you calling in from Plymouth Rock and spending the time with our CRT investors. Ryan?
Thanks, Mike. Thanks for a great presentation. Always a tough act to follow, and thanks everybody for having me today. While I am on vacation, visiting some family in Massachusetts, I always like to talk mortgage servicing and loss mitigation. So that's what we're going to do today. Really relevant lead-in, really with a lot of the things that Mike was discussing. So I think that's helpful to even kind of frame the issue. But with that, let's jump to the next slide briefly. So we're going to start with and focus really a lot on COVID-19 response. When we think about loss mitigation and really servicing policy in general since March of 2020, it has really been dominated by the pandemic, COVID-19 related hardships, and our response to that. So we'll focus a lot on that, and we'll also talk a little bit about what we've been doing when we're not focused on COVID-19 related hardships and trying to help those borrowers out. We can go to the next slide, please. So clearly, in March of 2020, we had a pretty significant hurdle to clear, and a lot of things that we were going to need to respond to. And I'd like to give a little bit of background as we kind of headed into the pandemic and what really helped us to be able to respond to that and to deal with it really goes all the way back to the financial crisis from 2008 and the aftermath of that, where at that time, most of the loss mitigation done by the GSEs, by Freddie Mac and Fannie Mae, was really non-delegated. So not as transparent, not as streamlined, a lot more steps to the process. And really what servicers would do primarily would be to collect the information from borrowers and then submit that to Freddie Mac for review, and they would get back the option for borrowers. And that worked back then until the crisis occurred in 2008, and then we had a volume problem. And what was a working process became a very inefficient process that needed to be overhauled. So in the years that followed, Freddie Mac and Fannie Mae, working with our regulator, FHFA, started to align on delegated loss mitigation policy. And so we would actually develop all of those programs in conjunction with Fannie Mae and under FHFA's direction. And so we based it on the concept of an evaluation hierarchy. So we do believe in responsible loss mitigation, of course, at Freddie Mac. And so the way that the evaluation hierarchy works is that servicers are delegated to evaluate people when they do face a hardship and to approve them for whatever the most appropriate option is. And the hierarchy manages those options sequentially, where it's really the best result for Freddie Mac would be the first one. It would be like a reinstatement. You can afford to just reinstate. And then as you proceed through the hierarchy, so the outcomes are potentially more costly to Freddie Mac, but also more significant assistance to the borrower. So it would be, like forbearance would be followed by a repayment plan, payment deferral, flex modification to generate payment relief if you can't afford the payment deferral. And then if you have to go into liquidation, unfortunately, we would evaluate for those things. And so that helps to kind of standardize the process for servicers across the high volume that they manage for the GSEs collectively. and then also to try to protect the GSE's best interest in identifying that order the way that we have, while also being able to provide borrowers hopefully workable solutions. And I think from some of the delinquency numbers Mike talked about, and I'll talk about a little bit too, we do feel pretty strongly that it's been working. So after creating this more delegated, more efficient process, over the years, we would kind of go from reactive policy, where we had several loan modification programs that were all kind of developed separately to address certain issues. Like we had HAMP, we had Standard Mod, we had Streamline Mod, we had My City Mod. And we had some time now, some breathing room in the middle of that decade to reevaluate the overall process and create what we kind of called the future of loss mitigation. And so we made more flexible programs that, an individual program like the Flex Mod replaced 4 different loan modifications, for example, and was designed to be able to be flexible, hence the name, and account for a wide variety of market conditions, borrower hardships, and things like that. And then we also had an off-the-shelf kind of disaster policy framework that we were able to create, because although our regular hardship policies work very well, certain things do kind of require even more specific policy to address. Disaster is kind of the most obvious example, but then we found ourselves in the pandemic, which is similar to a disaster. At least what we've seen so far in the results are that they do tend to perform similarly. It's a stronger performance than when it could be just any hardship reason, like if you just look through all of our eligible hardships, unemployment, reduction in income, divorce, there's just a lot more volatility when it could be anything versus when you kind of know what's causing the hardship. So we were able to go into the pandemic feeling as though we had a strong foundation with which to work from. But we also know that we need to be flexible, need to be nimble in developing more dedicated policy for the specific issues that we were seeing that were really unprecedented for the pandemic. So that brought us into March of 2020. And we immediately, what this slide shows is a lot of the things that we put out specifically to address the COVID-19 problem. And so that first bullet under 2020, we were able to lean on what we already had in place, that strong foundation, and just kind of get the word out there to provide assurance to servicers, to borrowers, to any other industry participant that help is available. We have these policies in place, follow those policies. In the meantime, we're going to work on developing some new ideas and concepts and adjusting what we have in place to more specifically account for this pandemic. And so we did that. We came out with, first, the COVID-19 payment deferral has been a very successful program for us to address the pandemic. Interestingly, the payment deferral concept was something that we had tested and piloted for several years, and then aligned with Fannie Mae. And it wasn't intended to be what it became during the pandemic. It was just timing-wise was announced on March 25th. So 1 week after we had our first COVID-related bulletin, this program that we had spent a year negotiating with Fannie Mae was put out there to help borrowers who had a temporary hardship, missed 1 or 2 payments, then got back on their feet. And so it was kind of like a hole in our hierarchy where we didn't have something to account for a borrower who couldn't afford to reinstate, but also didn't need the additional concessions of a loan modification. And so we put the payment deferral in place to address that. And it was really only for borrowers 1 or 2 payments past due who resumed paying. And so it happened to come out at the beginning of the pandemic. It wasn't really intended to solve for a 12-month forbearance that the CARES Act had put out at that time. And so we had to quickly work to adjust. And we knew that the payment deferral could be a good post-forbearance solution in these cases. And so within 2 months, we had a COVID-19 version that kind of matched the delinquency requirements to the COVID-19 forbearance at that time, going to 12 months delinquent. And then just 2 months after that, we also updated the disaster requirements to have a disaster version that could help in a similar way for a little bit later stage delinquency. But throughout this, we're doing other things, not all of them as impactful as a COVID-19 payment deferral, but we had to adjust our forbearance requirements to account for what came out in the CARES Act, which was similar to what we had in place, but not entirely the same. We had to be able to track these loans with reporting requirements. There was, of course, the foreclosure moratorium that was extended several times, that while we aren't responsible for, we did have to be able to try to provide more clarity and and putting that out there for our servicers to follow. That we put out flex mod requirements to kind of further streamline how borrowers go about getting a flex mod, and then later, as these delinquencies really extended for those borrowers that might have stayed on the forbearances, as that became extended to 15 months and then 18 months, flex mod was starting to get stressed a little bit. I mean, you only have so many levers you can pull. And so we opened up the rate relief to more borrowers than we typically would for COVID-19 impacted borrowers. So I would say those are the main things that we did throughout the pandemic. That there were some other minor adjustments for things like short sale and deed in lieu requirements for COVID-19 impacted borrowers. We addressed the Treasury program, the homeowner assistance funds, which is half, and put out a bulletin clarifying how to work with half, and especially as relates to foreclosure, because if somebody's going to be getting that money and is getting evaluated to be able to reinstate, we want to halt foreclosure and things like that. So now as we come into this year, we're really kind of focused on kind of closing the book on COVID policy, and we'll talk about that a little bit more as we progress through here. But I'll say next slide for now, and we'll cover that. So now we get into 2022, 2023, things are starting to normalize a little bit. And so we most of the bulletins that we've put out, or bulletins or our servicing announcements, were not COVID related. In 2022, we actually only had one COVID related bulletin. We issued 8, and some of the topics were starting to get back to things like system enhancements, technology upgrades, our new Resolve system, increasing its functionality, requirements around fair lending data elements, a lot of smaller updates like the early termination of making home affordable under Treasury, and then the resulting updates we had to make for cleaning up the guide around HAMP policy that was under MHA. And so kind of more around the edges stuff, not as impactful as the things that we were doing during COVID, but always with the kind of an eye looking towards the future and what updates we might need to make, what lessons were learned from COVID, and we're still learning some of those lessons as we look at performance and things like that. But with that, I think we can go into the next slide. All right, and I know Mike talked a little bit about STQ. I'm going to talk about it as well, a little bit of a different angle, because my focus is, of course, going to be on the loss mitigation aspect of STQ, and how things were working, how they compare to the past. And as you can see from this slide, this goes all the way back to 2010, which of course was the aftermath of the 2008 financial crisis, and we were still well within the realm of that crisis. And so you can see that year-end 2010, we had a 3.84% SDQ, which we never had anything that high for year-end serious delinquency rates during the pandemic. 2020 would have the highest at 2.64, still significantly higher than just 1 year earlier when it was 0.63%, but not quite as high as it was in 2010. However, I will note that mid-year 2020, we did have SDQ actually spike up to a little bit over 5% briefly. Some of that had to do with, I think, borrowers going on the forbearance because they were concerned that if they would need it, and we did see, as we'll talk a little bit about, a lot of reinstatements during that time, where I think people might have been concerned, took the step to go into the forbearance, and then realized maybe they didn't need it. And so the numbers then from that point on, and that was like late summer 2020, we're always kind of trending down. And then in 2021, we got to the end of 2021, it was 1.12 SDQ. And of course, as we get into 2020, the end of 2022, we're almost down to pre-pandemic levels at that point. And then we actually, as of now, most recent posted rate is 0.58% that we put up on our website a couple of weeks ago, which is below the pre-pandemic level. So we've seen some really good movement in SDQ, and a lot of that I think is because of the work that we've done in loss mitigation. There are other factors that Mike addressed, but I'd like to kind of cover what were the solutions that these borrowers were getting. And so I think we can go into the next couple of slides, and we'll dig into that a little bit. So here's kind of more of another like transition slide. As we could see, the end of 2022, or the beginning of 2022, we went into the year with a 1.12 SDQ rate. Really, by the end, we were kind of normalized. We're back down to 0.66%. And I do want to also point out that although 1.12 is significantly less than it was just the year before, which was again significantly less than the year before that, we hadn't been over 1% since 2016. So, and that was, we finished 2016 at 1%. So, it had been a long time that we even went over one. So over 1% was still pretty high. So going all the way down from there to 0.66 was very meaningful. So how did we get there from a servicing perspective? I mean, there are obviously a lot of factors. Well, one would be policy. I mean, we continued to issue bulletins, issuing 8 in 2022. As I mentioned, 2020 was the craziest year. We did 52 bulletins between the selling and servicing side. I think the servicing side was the lesser, but we still had about 20 servicing bulletins that year, which is a lot. We scheduled 12 bulletins a year, and we did 52 in 2020. So, but policy needed to continue to come out, continue to provide clarity. So we did that. Education. We hosted 9 webinars for servicers, also other industry webinars for borrowers, for other industry participants, and we're able to provide a lot of education to a lot of people on how our policies work and what the programs do. Collaboration with our servicers, and we have advisory board meetings with them, with the top 15 servicers. We like to get feedback. They're the ones on the ground doing the work with the borrowers. We also like to work with other industry partners and to get feedback, and also our internal colleagues who work with our investors and people like that. That's always of high concern for us as well. So that's a big thing. And then the programs themselves, and so in 2022 alone, we did 77,000 forbearances, 61,000 payment deferrals, 44,000 flex mods. So all of those people were able to get assistance and some help. So with that, let's go to the next slide, and we'll kind of get a little bit more detail on how things worked during the COVID era and what borrowers were getting. So one thing, we had over 900,000 forbearances during COVID-19. And over 97% of those are done. So that's just a pretty crazy statistic that we had forbearance increase to that level, and because people needed it, they really did. And it is reassuring to see that most of them have been ended, and most of the borrowers are performing and doing well, as evidenced by our delinquency rates. But there was also different trends throughout the pandemic. As you can see from the chart here, early on, we did have more reinstatements. And I think, again, that was probably because some of the people that would go on the forbearance as more of a cautionary measure ended up just relatively quickly reinstating. You also have the shorter term delinquencies where borrowers can reinstate. And then as time went on, you start to see at the beginning a lot of payment deferrals where borrowers couldn't afford to fully reinstate or do a repayment plan where they have to pay more, but they could afford to make their regular payments. So the payment deferral just takes the payments that you've missed and it puts it into a non-interest bearing balloon at the back end of the mortgage, and reinstates the loan that way. So you kind of just pick up where you left off, and you're able to continue. We saw a lot of borrowers who were able to do that. And then the lighter green bar would be mostly flex modifications. And with the flex mods, you saw very few of those for a very long time during the pandemic. But as time went on, you start to see that bucket getting a little bit bigger and eating into some of the payment deferral bucket. And the reason for that is that as the time went on, these delinquencies that were being resolved were no longer 6 months, 7 months, 8 months. They were 12 months, 15 months, even 18 months. And with that long of a hardship, the flex mod started to be more necessary for borrowers to be able to reinstate. So last point, this last bullet on this slide is pretty important. Workout activities decreased by 50% since January 2022 and bring us back to pre-pandemic levels. Also a really great sign that we're on the right path here, is that the STQ rate's low, that's great, but so is workout levels. So we're not having as many borrowers who are coming to us with delinquencies that need to be resolved, with hardships, with things like that. Next slide, please. All right, so that kind of is a snapshot of where we were going into the pandemic, where we were during, and where we are now. I think from both loss mitigation perspective, some of the statistics. And now what we're trying to do is we need to start to move on from our COVID era policies. They were always intended to be temporary, so we will work to retire those. And we are currently actively working on that, so we hope to have something out soon. And the primary things that are going to need to be retired are COVID-19 forbearance, the COVID-19 hardship itself, which we, it was important for us to be able to track those loans, but now the underlying hardship can be reported for new hardships going forward. So it wouldn't be just it's a COVID-19 impact, it would be unemployment, reduction in income, and be treated like more of a normal standard loan. The COVID-19 payment deferral will be retired at some point, and then also the COVID-19 flexibilities with the flex mod. Flex mod is the flex mod. It generates payment relief for people who need it, but there are some additional flexibilities for COVID that we'll be retiring as well. Next slide, please. All right, other servicing policy updates. We'll go through this relatively quickly. One of the things that we did already learn from the pandemic is that the payment deferral worked, and not just for very early stage delinquencies, but as a transition from borrowers on forbearance. So we've expanded that. It used to be just 1 or 2 payments past due, and you could that's it. That's all you could qualify for. We've expanded that to 2 to 6 months. So we're no longer going to do them for the 30-day delinquencies, which we used to do. We're still doing technically until the full change takes place. And the reason for that is that you miss one payment, there's a lot of volatility in that bucket. So we don't want to give up any concession, even if it is a minor one with a payment deferral. Those borrowers much more likely to reinstate, and so we will, while expanding further into delinquency to help more borrowers, we will kind of also make the change to be a little bit more conservative in that 30-day bucket. You can do more than one payment deferral now for the life of the loan. An individual payment deferral is capped at 6 months of missed payments, but life of loan, you can get up to 12. So you could have 6 and 6, you could have 4 and 4 and 4, or you could hopefully only need one. But there are other requirements to ensure people aren't just churning payment deferrals. You can only have one in a 12-month period, things like that. Previous mods also would play into the evaluation. And within 3 years of payoff of the loan, whether it's maturity or early payoff, you wouldn't be eligible because you're just going to end up having to pay a balloon payment very quickly in that scenario. Okay, next slide, please. And then other servicing policy work, we'll just very quickly breeze through this. A lot of what we're doing now is technology related. So Resolve is the biggest thing. It's going to replace Workout Prospector. It's already largely replaced it, and it's just a better, more automated system. We're committed to our equitable housing tactics under FHFA's Equitable Housing Directive. So several tasks associated with that listed here. Borrower education is always a big one, and as well as just really all of the things that we're doing in that space. Notifying borrowers who do have, now that we're using these deferred balances more, notifying borrowers who do have a large deferred balance that it might become due so that they can plan for that. Automating our assumption evaluations if a borrower wants to assume or a non-borrower wants to assume the mortgage. We have recently announced our Heritage One product for Native American borrowers, and so there's servicing requirements associated with that, with different rules because of different mostly legal reasons. And we do want to look at loan modifications, and we don't have any imminent changes in that space, but it is a very challenging environment for loan modifications, and so it's something that we'll continue to monitor. So I am conscious of taking up too much time. I do think we're going to now turn it over for questions, and we'll be able to take some questions.
Thank you, Ryan. And I'm going to turn to Cindy, but I have all these trophies behind me. I will share that we handed out We Are Less Than One back in 2016 when we broke the 1%. And I still got that.
I have mine as well. That's great.
So Cindy, yep.
Yes, thank you. So if anyone does have questions, please feel free to enter them in the Q&A box. I do have 2 questions so far. The first one, how important is borrower education and awareness to the loss mitigation process? What resources does Freddie offer to borrowers to help educate them on potential loss mitigation solutions?
Yeah, so I'll take that one. Thank you for that question. It's a good question. So it's critically important. I mean, for borrowers to understand that there are options available and to have a little bit more comfortability knowing that they can talk through these things with their servicers really greatly increases the chances of success for a borrower when they do run across some type of trouble. I mean, a lot of borrowers, if they're not aware, just won't pick up the phone, won't open the mail just because of the uneasiness associated with that delinquency. So, knowledge is power. It really is important. And so we do try to provide a lot of resources to help people understand that, and including we have a My Home website, which is very borrower friendly, and it can walk you through all the different things that might be available to you based on your circumstances. It'll guide you that way. We have communication and outreach standards for our servicers. Our servicers are so important with borrower education. They're the ones that are going to be talking to them about the specific issues. So, we try to arm them with a lot of information, and including things like letter templates and communication guidelines and scripts and things like that. Borrower counseling, we try to make available whenever we can. And so all of those things. But just one last point that I'll make with respect to education and how that impacts outcomes. We see that borrowers on forbearance are significantly more likely to perform better than a delinquent borrower who's not on forbearance. And I think that's the combination of engagement and then the education you get with engagement. And we do see that pretty consistently in our numbers. So I think there's data to support the theory that education matters, and something that we definitely try to support as best we can.
Great, thank you, Ryan. We do have another question. When developing a loan modification program, how do you evaluate for the financial impact to Freddie Mac?
Yeah, that's certainly a relevant question for this group, and we absolutely take that seriously. It does evolve and change over time, and there's been different ways in which we look at that. Back when HAMP came out, it was at the loan level, it had to be what we call NPV positive, which is our kind of our basic financial analysis on a mod program or a mod itself. So every single loan that went through HAMP had to have an NPV positive result in order to be approved. Since that time, we've gone to more of a program level analysis when we're putting together a program, and it's still based on NPV, but as long as the program itself meets a certain threshold of NPV positivity, we don't necessarily do the loan level analysis for every single loan coming through. But we do it with the stress tests. We make sure that we're accounting for kind of swings in all different directions, and we do try to create financially responsible programs to help borrowers, and that's very important. But some of it is also going to be dictated by our regulator and whatever what their concerns might be given a certain market or a certain time.
Regulator and conservator. And Brian, I know we learned so many things through the crisis and improved our programs. One thing I would highlight is we certainly became more aware that taking properties through REO and putting them onto the market could actually reinforce the spiral of lower and lower prices as you put distressed homes. Once distressed homes exceeds a certain percentage of total homes for sale, it has an outsized effect on the region. And so certainly that's another argument for home retention, has direct contribution to lowering credit losses.
Absolutely. Great point, Mike.
Okay. Any CRT tenders in the coming month?
We are scheduled. Our plan is to potentially execute a CRT tender once per quarter. That's based upon market conditions. So I think probably not August. That's not a great time frame, but we'd be probably looking to execute something after that.
Okay, and it looks like our final question, is there any concern on recent reports around increase in new delinquencies in auto loans, increase in credit card debt?
It might be for you, Ryan.
Yeah.
I mean, I think the general question of all financial markets are interrelated, right? And is that a indicator of consumer health in those other segments?
Yeah, I mean, I think it certainly could be, and I think that what we try to do with Freddie Mac as we consider loss mitigation is that we do try to have solutions in place to account for really any hardship, financial hardship that could occur, and those would qualify as financial hardships under existing policies, where if it starts to impact the borrower's ability to make their mortgage payments, they can be evaluated under the requirements that we have, and as long as they're meeting the criteria, then there should be a solution for that borrower, as long as it is appropriate for both Freddie Mac and the borrower. And so, with those solutions in place, we do feel pretty strongly that we're able to account for hardships that might come up, that might be something that is related to other debts and responsibilities that the borrower that could be indicative of the borrower maybe trying to hang on, but maybe it's going to start to spill over into the mortgage debt as well.
Great. And it looks like we had one additional question come in. Could a borrower who receives 12 months of payment deferral look to refinance and be able to get another 12 months of payment deferral?
So if they refinance, it's a new mortgage, so that it would have it would no longer, none of the history from the old mortgage would follow it. So technically, a borrower with a new mortgage and a new loan, the requirements from a past mortgage would not affect that one for purposes of any future loss mitigation evaluations.
And that
sorry, Mike.
And I was just saying that refinance would be a qualify. It had to be re-underwritten at that point in time, just like a regular loan. That, from a CRT perspective, once the loan refinances, it pays off out of the pool. To the extent that that loan then gets refinanced and delivered to Freddie Mac, that may be included in the future CRT pool. But to Ryan's point, it's all independent.
Right. Yeah. And the delinquency that would have had to have been resolved with the payment deferral, as well as the payment deferral itself, would be things that would likely hit the credit report. Of course, the CARES Act protected borrowers' credit for the period of forbearance if they were covered by that. Payment deferral would still be reported under the CARES Act, depending on your interpretation. But then, the CARES Act is no longer relevant. So, even now, any delinquency should be reported. So that should all be, contributing factors to their ability to get the refi as well.
Ryan, thank you. Ryan, thank you so much for taking the time and for all the work that you do here. And thank you, everybody, for signing in and listening to us. If we had any other questions that you may have had but we couldn't get to, please reach out to any of your CRT representatives. And hope you all have a great summer, and look forward to continuing to doing business with you. Thank you.
Thanks, everybody.